All right, good morning, good afternoon, or good evening if you're joining us from the Far East. Firstly, we'd like to apologize for the delay. It's not very Swiss of us, but we had some technical Zoom issues. So thank you all for bearing with us. With that being said, action-packed agenda today, and as you can see as well, I've got a lovely colleague, Michael, with us. You guys who have known us for some time now will already know Michael. He's been part of this call during summer months when the spot Ethereum ETFs were launched in the US. So he's here to also provide a lot of insight, particularly from the cap markets angle. He's a great addition to this call, not only because he shares a last name with a famous economist, but also because he has a lot of good insights he will be sharing with us today. You guys saw in the invite that we wanted to focus kind of on why Bitcoin was struggling to break 100K on Bitcoin and gold. But of course, we've had the recent news of Bybit's hack, so we are also going to unpack that. With that being said, let's first do a quick kind of month in review. Um, I think that's important because this is kind of where we left you guys off last month, where we said, there's plenty of tailwinds for the industry. There's plenty of good news coming out, particularly from the US. And that is still true. And we did see that also towards the end of January, that prices, the Bitcoin price started to pick back up and broke again the 100K mark. But since then, we've had maybe a bit of a difficult month. I think we can both agree here, Michael. Um, so we started off the month with the news in the US that Donald Trump was imposing kind of wide range tariffs. This has since toned down. His language on tariffs has since toned down. But that weekend, the early February weekend, Donald Trump did announce his will to tariff both Canada and Mexico. Of course, it was later announced that this was delayed, but we did see a clear trend during February where crypto assets and specifically Bitcoin was quite reactive to macro data points. We saw what followed that period, following the tariff threats, was what I would say a kind of period of consolidation or where capital, a lot of capital, we feel was sidelined from market participants because they were waiting for the next significant development. We had a lot of pro crypto rhetoric at the beginning of the year and at the end of last year. And so, in our view, the market was waiting for something structural to really change. We thought it would be some positive news, maybe, a state in the US finally getting to the final phase of a strategic Bitcoin reserve. But unfortunately, we were faced with the bad news on Friday that Bybit, a large centralized exchange, was actually faced with the largest hack in the internet history, worth around $1.5 billion. So we're going to unpack that a little bit as well. But what we've seen since then is that capital has flown out of the crypto economy, and that maybe some participants are trying to de-risk their crypto exposures. So let's break down the Bybit hack. I think that's a good place to start. I mentioned already that it is the biggest hack, not only for crypto, but of the history of the internet. And just to put it at a high level, for those of you who either didn't yet read our newsletter, where we unpack this in more detail, but it was a really complicated attack. And it was one where the hackers, the group that was identified was the North Korean group Lazarus Group. And essentially what they did was siphon around $1.5 billion worth of Ethereum or Ethereum equivalents to one of their own wallets. What was positive, though, I would say, is the fact that this is another test of blockchain technology, right? Thanks to blockchain's open source nature and the fact that you can trace transactions, quite easily, the attack was, identified in a short matter of time, and actually the whole crypto kind of community worked together to identify who did it, identify the size, and also the potential vulnerabilities. So for instance, Bybit was able to already fully plug the hole that the hack left. So they were fully able to replenish their 1.4, $1.5 billion worth of Ethereum by securing loans from other centralized exchanges or other sources like Binance and BitGet. But nevertheless, another positive, or not necessarily positive, but at least what we saw from the Bybit hack was that Bybit was able to continuously process their transactions. So of course, the hack meant that people were concerned about whether their assets were still safe. And so this meant a lot of, people with assets in Bybit started to withdraw. So there were around $6 billion worth of assets that were withdrawn in the immediate aftermath of the hack. And unlike in previous centralized exchange concern or problems or concerns, like we saw with FTX, Bybit was able to continue their operations, which was a positive for the industry. I think they had around 350,000 withdrawal requests, which were all processed normally. But of course, I think more than anything, it again raises the question or begs the question about how can we access crypto? How can we get exposure to crypto in a safe manner or in a transparent manner, but also without sacrificing accessibility? And, the predominant way or the main way that mainstream investors usually get their crypto exposure, I would say, is via these centralized exchanges. These centralized exchanges, have a very large asset coverage. You can trade a lot of different crypto assets, and they also offer real-time settlement and 24/7 trading. But as we saw with FTX, and as we now also saw with Bybit, it does introduce a kind of fragment of counterparty risk. The other option for going direct is by custodying the assets yourself. However, I feel that for a lot of investors, particularly those who have just started their crypto journey, that requires a lot of technical knowledge. You need to be able to manage your keys properly, and you need to be able to be confident enough to do these transactions uh, on your own and storing these assets on your own. And as we saw with the Bybit hack, that doesn't necessarily mean you're safe from being targeted by hackers. So this begs the question again, how can we access these assets? And I think, of course, this is what we do at 21 Shares, but we do think that another option is by accessing crypto through ETPs or ETFs. And maybe, Michael, you could give us a couple of words on what are the benefits of accessing via ETP or ETF compared to the other routes?
Yeah, absolutely. And thanks, Max, very much for having me on the call today. I think one of the major advantages, right, of ETPs, and this is something, that we're quite familiar with on our side is, access to institutional grade custody. Those are segregated cold storage wallets that are held with regulated custodians. We do a lot of due diligence on our side, and I know other issuers do as well when choosing which custodians to work with. So this is a really important thing for investors to know is that their assets are never commingled with the exchange assets and are always held, segregated and in name of the trust that they're held in.
Yeah, exactly. And I think also that's a great point, the fact that they're segregated. A lot of people maybe have that misconception that you still bear a counterparty risk with us. But, as Michael just said, even in the case of insolvency, From an issuer perspective, the assets are ring fenced. So even if an ETP issuer were to go bankrupt or be insolvent, the fund assets, the client assets, they still remain untouchable from ETP issuers. So it limits that counterparty risk. And in terms of accessibility as well, I would say for mainstream investors, it's far easier to get this exposure traditionally via your brokerage account or traditional route than opening up a new account on a centralized exchange that still bears that counterparty risk. But yeah, well, one thing that was obvious is the market effect. Maybe Michael, what did you see following the Bybit hack in the market?
Yeah, absolutely. And I think, obviously, as this chart shows, it started kind of long before the Bybit hack. Obviously, the beginning of the month, around the time that the tariffs were announced, we saw a mass wave of forced liquidations. This is typically for perpetual futures, which are futures contracts with no expiry, that take place in the DeFi market. So, throughout most of the month, it was fairly flat, and then liquidations were pretty mild relative. And then, as Max mentioned, the Bybit hack happened this past Friday. And since then, we've seen quite a large wave of forced liquidations happen again in the market, essentially forcing deleveraging, which, may actually be a good thing for the market health overall, especially, as we'll jump into in the next slide, kind of the range that we've been trading in quite recently.
I agree exactly. I feel that a lot of kind of leveraged positions were likely also opened up following the US election, following the expectation of what Donald Trump and the pro-crypto administration would bring to markets. And so as a result, now, of course, these are forced liquidations, but it is a healthy correction, right? Maybe the market was becoming slightly over leveraged, and now we're at a phase where we can have more sustainable growth. But since you're on the call with us, Michael, I want to make sure we also kind of nibble at your expertise. And of course, Michael works in the capital markets team, so he's really focused on what do we see from ETF flows, ETP flows, but also what we're seeing from institutional adoption as well. So I think this is a good slide, which earmarks what we talked about in the previous slides, that we have been facing a little bit of a turbulent time in the last month.
Yeah, no, absolutely. I think as we see here, right, there's quite a lot of gray candles here on this chart, which suggests, we've seen quite a number of outflows since the beginning of February. There's quite a few factors that are affecting this. This chart was put together too a day earlier than this call. So we didn't capture yesterday's outflows, but yesterday's outflows out of the spot Bitcoin ETFs in the US was the largest day of outflows that we've seen, with just north of $1 billion in outflows. What's really driving this is partially, the basis trade. I'm sure some people have heard about this in the past, but really what it is are sophisticated institutional players are taking typically a long position in the spot asset, or in this case, the spot Bitcoin ETF, and then taking another short leg in the Bitcoin futures to take advantage of a price dislocation between the two. If futures contracts are trading richer than the spot is at that given time. So we've seen that basis collapse quite a bit over the course of February. And this is really, what's driving a majority of these outflows, is kind of that basis collapsing and them closing their positions and taking profits.
Makes sense. Yeah, so I feel like it's kind of twofold, right? Maybe the market sentiment had shifted slightly, and institutions and the ETF flows kind of mirrored that side of the flows, but also on the institution specifically, they're very much interested, and we've seen this over the last few months, that they're very much interested in these tactical plays, with the basis trade being a significant one. And if that compresses, I think it's actually now around half the average of last year. It means that the appetite for institutions is a little bit smaller in the near term. But I think it's also worth zooming out. You know, people worry, or do we really see institutional adoption, or is that just something that we're saying, right? But if we zoom out, I think we've seen a gradual increase in institutional participation. And maybe, you know, with the recent 13F filings, you also have some nuggets of information that you'd be willing to share.
Yeah, for sure. Absolutely. Yeah. So I think as Max highlighted, despite the recent outflows that we've seen in the market, 13F reporting was due last week. And it highlighted quite a positive trend within within the growth of the institutional holders across the past year since these ETFs launched. We've seen essentially a 3x from Q1 to Q4, which is quite significant. Institutions are now holding about $31 billion worth of spot Bitcoin ETFs. And that number is, as we've seen last year, is growing at quite a significant rate. The largest percentage of these owners are hedge funds, which is a group, as we mentioned before, one of these sophisticated market participants that's taking part in the basis trade and is finding these, very interesting tactical opportunities to enter the market. Which, they make up about $13.8 billion of that $31 billion figure there. So quite a significant portion.
Makes sense. Yeah. And I think, you know, for people on the call who that may be wondering, you know, okay, but compared to non-institutional, compared to retail, I would say that the pie has stayed the same. The proportions have stayed the same. You know, it's around, I would say, 30% of the holdings are institutional holdings. But as that pie grows, so does the portion that is belonging to institutionals. And we do expect that pie to grow significantly over the year, right? We've seen just how much institutional adoption has picked up over the last year from the 13Fs, but we've just generally seen how much demand and how much appetite there is for crypto ETPs worldwide, generally speaking. I mean, if we just take a step back and from the US spot ETF launches last year, these ETFs have accumulated over 110, 120 billion in assets in just one short year. And they've actually overtaken the gold ETFs in the US when it comes to assets under management. And when we think about the demand and supply dynamics, they've actually accumulated more than double the supply of Bitcoin that was issued in the last year. So all of this is a very, very favorable outlook, I would say. But do you expect institutional adoption to slow from here, or what do you think, Michael?
No, I think quite the opposite. I think this is still very early innings, especially for not only this asset class, but also these instruments. So I think our outlook is that institutional adoption will continue to increase. Especially as we're hopeful that, the assets available to these institutions continues to grow as well.
Makes sense. Makes sense. And of course, we've got to remember, right, that like the US market is a very important market, but it's still not the only one. And we may see other institutional adoption in other key markets as well. And I don't know if you have the data at hand, and I may be kind of throwing you under the bus here, but we did have the opening up of the spot ETF options, the Bitcoin spot ETF options in October, November time, which actually, as you mentioned, is particularly interesting for those more sophisticated players. It lets them set up tactical plays like the basis, but also among others. And so do you see a lot of demand for the spot ETF options as well?
Yeah, absolutely. I think demand has been extremely strong for those options and is continuing to grow. In terms of the volume number, I don't have it offhand, but I want to say it's around, $6 billion a day in notional trading volume on the options. Obviously these are just another instrument for institutions to, hedge their exposure or, create synthetic exposure or really, do a whole host of things with structured products. So yeah, I think this is going to continue to grow as well. We're quite bullish on that kind of that product structure.
I mean, makes sense, right? If we compare the kind of volume of options to the spot markets in other asset classes, the options markets and the derivatives markets heavily outweigh the size of the spot market. Whereas actually for crypto, it's still the opposite. It's still the fact that the spot market is usually far larger than the futures or derivatives market. So we could still expect that to continue to pick up in demand and therefore continue to pick up more institutional adoption.
Yeah, absolutely. And I think, it's important to zoom out a bit here and think, these regulated options in the US have only been available for 4 months now. So they're still infants, if not babies. So I think, adoption will definitely continue to grow there.
Cool, thanks a lot. And I think also with the fact that, there has been a slight downturn, the fact that the last month has been difficult for Bitcoin and crypto assets does beg the question, where do we go from here? But also, is there something fundamentally driving this? And we would say, the hack, the Bybit hack, is not a reflection, particularly for Bitcoin, not a reflection of its fundamentals, right? The fundamentals for Bitcoin still remain very much intact. Bitcoin is still the only scarce asset, the only limited asset in the world, the only truly limited asset. And as a result, we still believe the narrative of it being an emerging store of value definitely still holds true. So nothing has been actually infringed upon in terms of what Bitcoin stands for. Um, and I think that's still quite important. And when we looked at the last month, Michael and I noticed a trend, of course, that Bitcoin had been struggling, whereas actually gold had been reaching continuous new all-time highs. And that's why we wanted to cover these two assets. We think Bitcoin is still very much like gold. We always like to say, if you like gold, you probably like Bitcoin, but you just don't know it yet, or you're already allocated. And the reason for that, I would say, is because, uh, firstly, of course, it's a scarce asset, it's limited in supply, but also because Bitcoin, not only is it like gold in its fundamentals, but it's also improving upon a lot of the drawbacks that gold has. So Bitcoin is easily transferable, so it can send easily via like sending an email. It's easily storable. You can store it on a USB stick, or you can invest in it via ETPs or ETFs. Whereas for physically storing gold, it's expensive and it's difficult to transfer. And again, while it's also difficult to do this, gold is still subject to counterfeit. I'm not sure if you guys have been following the story of Fort Knox and the fact that they want to go there and check that all the gold bars still exist in Fort Knox. But there are concerns, or there are rumors circulating that some of these bars may actually be counterfeit, and this problem does not exist with something like Bitcoin. So I think it's still worth doing this kind of comparison because we see institutional adoption pick up. We see it from, as Michael mentioned, from the ETFs, from potentially institutional adoption via basis trading, but we also see institutions invest in Bitcoin potentially as a strategic reserve asset. We've seen Strategy continue to ramp up their adoption for this very reason. And of course, in the US, we still have, over 20 different strategic Bitcoin reserve bills open at the state level. And that's particularly and precisely because of this core proposition that Bitcoin is an emerging store of value. And Michael, I say emerging for a very specific reason, I think, because some people here might be thinking I'm a bit crazy. Bitcoin still suffers significant volatility compared to gold. But I think you found an interesting angle, which I'd be happy for you to share.
Yeah, absolutely, Max. And I think for gold, you have to look back to 1970, right, when the US removed the gold standard kind of from our pegging of the dollar. And for the years that preceded that, it was quite a volatile asset. I think it was probably 40 or 50 vol asset, similar to where Bitcoin is trading today. And that's something to really keep in mind as Bitcoin is also just a nascent asset, similar to what happened to gold then, as there was no real, proven use case at the time other than, it being this reserve asset for the dollar and dollar pegging.
Exactly. And I think you put it exactly right. As we also transition to more of a digital world, having something like Bitcoin, the benefits of having something like Bitcoin will become more and more apparent. And as the asset continues to mature and as more market participants buy into this idea of it being like digital gold, we will see that volatility come down significantly over time. But I think for those for people here in the call, they are obviously interested. Does that mean Bitcoin should replace gold in my portfolio allocation? Does that mean they can both play the role together? And what do you think, Michael?
Yeah, I don't think that's our view at all. I think they're quite complementary assets, held in the portfolio together, right? When you look at the two of them, obviously the correlation between the two is extremely low at 3%. But even their, correlations to equities and US bonds are also extremely low. And this provides, that nice diversification that investors are looking for, when they're, trying to diversify away, some risk to the markets, more broadly.
Makes sense. And this is a snapshot, right? So some people here may be like, well, we are potentially cherry picking, but it's still a 4-year window, which includes both a bear and a bull market. So we thought this is a very viable kind of illustration of what a standard static correlation can look like. But of course, we also took a look at how Bitcoin and gold's correlation oscillates over time. And I think you see here, it remains within a fairly reasonable band, right, Michael?
Yeah, no, absolutely. And I think, even on average, when you look at it, right, it's near zero or even below zero, the correlation between the two assets, which is great to have in a portfolio.
Precisely. And that these are all the numbers. And now I think from a research perspective or from how we like to think about it is because in the investor's mind or in I think the mainstream's mind, Bitcoin is still considered a kind of risk on asset, whereas gold, has over a long period of time been uh, been considered a flight to safety, and this is the fundamental proposition of gold. We know some people use it for jewelry reasons or maybe for kind of production reasons, but largely the large portion of demand comes from the idea that gold is a store of value. And here we kind of looked at the return profiles from both, well, you also have the S&P there, but if we just focus on gold and Bitcoin, we kind of looked at the return profiles from the geopolitical events that we've seen over the last few years. And usually, of course, when there's any kind of crisis, gold tends to rally off the back of it because people search for safety amid uncertainty. Whereas for Bitcoin, that's not quite the case yet. I would say Bitcoin is still considered a risk-on asset by many investors. And as a result, we actually see it kind of turn downwards or be quite volatile in the short-term reaction. But as more people understand the value proposition of Bitcoin and as more people are affected by these geopolitical events worldwide, the more they start to turn to Bitcoin. So a good example, I think, was the kind of conflict between Russia and Ukraine. People did flee, of course, to gold or gold derivatives at first, but once the financial system in Ukraine was severely hampered, people actually started to turn to Bitcoin to be able to send money to their loved ones and do cross-border transactions and whatnot. And that's a cool example, I think, of Bitcoin's proposition being taking a little bit more time to understand it, but also shows also with the return profile that the proposition of Bitcoin is more understood in the longer term. And yeah, we do believe that more and more people will start to see this in the short term as well. But given that it's still seen as a risk-on asset, they can play very complementary roles in the portfolio as well. Cool. And then given the buyback, of course, I think it's important to also take a look at where are we right now and where could we go from here in terms of price, in terms of near-term movements. So we put together this chart, and maybe Michael, you can kind of walk us through this.
Yeah, for sure. So obviously, looking over the last year since these ETFs launched, obviously we're at a critical support level here of 88K following the Bybit hack this past Friday. Obviously, this is a range that or a support level that we're testing currently. We've jumped between 86 and 89,000 over the last day and a half. But if we break through this support level to the downside, I think we'll likely retest that 72K level as that's really where that price discovery was last kind of initiated here. But if we hold at this support, I think we're fairly confident that we'll see at least a nice bounce higher to kind of the highs that we saw earlier this year and at the end of last year.
Makes sense. Thanks a lot. And I think it's exactly as you said. This really between 72 and 88K is largely untested. Hopefully we don't break to the downside. But nevertheless, I do still think it's worth remembering that drawdowns, they are common during a bull run. And this is specifically to Bitcoin, but they are very common during a bull run. So while we may face more drawdowns potentially, it's still very much in line to what we've seen in previous market cycles. And we kind of broken down what we call the early bull and the euphoric bull. But here you can see that as of now, we believe that the market is currently still in an early bull stage. And this kind of correction or this consolidation may be an important one to, as Michael mentioned earlier in the call, to flush out excess leverage and to bring us back to more of a healthy kind of upward trajectory. But yeah, the drawdowns we face now, I mean, even still, if you compare within this bull run, it's not comparable to the drawdown we even saw during the yen carry trade. And if you compare to previous drawdowns, Bitcoin faces a 20% drawdown quite commonly in bull markets. And even in 2021, when China banned Bitcoin mining, we saw drawdowns as large as 60% during a bull market. So this is nothing new, I think, for more seasoned investors. But for those of you out there that are concerned and may think that this is a potential signal of the end of the cycle, we do have a report that highlights how we don't believe it is, but also to remember that drawdowns are still common during a bull market. And I think this brings us to this point that for investors who are willing to build or keen to build a more long-term allocation into the asset class, right now we have quite a lot of discounted prices. I mean, Bitcoin is currently around the price of when the election was won by Donald Trump. But think about also all the kind of positive news and all the pro-crypto developments that we've seen in the market since then. So it could present a fairly discounted price. And if we look at altcoins specifically, a lot of them are actually at the price of, August 2024, with a couple of outliers actually being in the same prices as we've seen during bear markets. So right now, for those of you who want to build a long-term allocation, these prices may provide a great strategic entry point. Now, we're not saying that we're only going to move up from this point onwards. The market is still facing some potential risks, but at the same time, if you're building a long-term allocation, right now is a good opportunity. And yeah, here we have a couple of the kind of tailwinds and headwinds for the industry. I think the tailwinds are the fact that money supply continues to grow since the start of January. We've seen that Bitcoin and global money supply do have a strong correlation. When there's more liquidity in the market, people tend to buy into more risk on assets. As Michael mentioned, we do fully expect institutional adoption to continue. There is the pro-crypto government in the US as well, and they bring along with them more regulatory clarity, like we've seen with SEC dropping the investigation into Coinbase. And they also, of course, may potentially introduce a strategic Bitcoin reserve. So there's a lot of positive tailwinds and potential tailwinds, which is why we think right now presents a great opportunity for long-term investors. But of course, that doesn't necessarily mean that we are only going to go up from here. There are still headwinds in the market. The first being that Donald Trump's kind of protectionist measures, it's still fairly uncertain how that will play out. Secondly, we've had the numbers last week as well from the CPI in the US, which indicated that it is a little bit of hotter inflation than what we would have hoped for. And markets are now pointing to the fact that interest rates will be higher for a longer period of time. And as a result, we may see, less appetite for risk assets. And then I think there are some crypto-specific issues, particularly also with Solana, which is why that crypto asset has been under some pressure over the last weeks. We have the unlock of $1.5 billion worth of Solana from the FTX estate. And of course, we've seen a slowdown kind of the speculative meme coin activity that was driving record activity for Solana. We've seen that slow down ever so slightly. And also with the recent downturn, we don't necessarily expect that kind of, frenzy to pick back up. So here we kind of put together the tailwinds and the headwinds for you guys, and altogether, this can help you paint the picture of whether right now, for you guys, is a strategic entry point or not. We believe it is, especially if you're building a long-term allocation. Cool. I think that's it from our side. If unless you want to add anything yourself, Michael.
No, it was great to join you, and I'd love to answer any questions that the audience might have.
Yeah, so I guess now we can open it up to Q&A. If there's any questions, please feel free to shout at us. We'll be happy to answer. There's no questions as of yet, so either we've done a good job of answering all the questions they may have had. There we go. A question on the MicroStrategy liquidation spiral is a great question. We actually broke this down in more detail in one of our reports recently, which you can actually find on the website. So we'll definitely feel free to check that one out. But it's hard to pinpoint how likely a liquidation spiral is. I think when we did the analysis, if I remember correctly, we would need the prices to still come down quite a lot, I would say. I think it was around 60K where we kind of identified a potential pain point. That's not to say that they would then have to sell off all their Bitcoin, but that's when, we start reaching murky territory. So in terms of likeliness, I would say that typically at a new height, at the market height, the bear market usually shaves off around 50-60% of that. And if we're at a new height of, let's say, 100K to 150K, we don't necessarily get to treacherous territory yet. But of course, if they continue their accumulation at higher prices, they will face a potential spiral earlier than we expect. Cool. The second question is, what do we think about Bitcoin miners. If you would like to maybe expand on your question, just so that we can answer it as accurately as possible, I think that would be great. Just because, I'm not quite sure of what direction your question's headed at. The third question is, could you elaborate a bit on 21 shares new ETF filings or other altcoins? And then what do you believe could be the potential impact on global altcoin liquidity and asset pricing dynamics? Of course, we are not able to answer anything that is not yet, publicly available from our side. But what we have seen is, a lot of different filings, whether it is for something like Solana from other market participants as well. But maybe Michael, you could kind of elaborate a bit on what do you think of new potential ETF filings this year in the US?
Yeah, I think I'm happy to speak more to the altcoin liquidity and asset pricing side of this
Yeah.
question. Obviously, don't want to comment on any active filings that we have in the market. But as far as global altcoin liquidity and asset pricing dynamics go, right, from capital markets perspective, we think this is a net positive across the board for altcoins that are being filed for, as well as that universe more broadly. Obviously, this brings more market participants into it, which ultimately brings more liquidity by bringing more market makers and traders to that space. From an asset pricing perspective, obviously, I think if there's demand for the assets, we've seen kind of the result of that over time, especially with the spot Bitcoin ETFs. They've driven price upwards quite a bit. But I think as far as liquidity goes, yeah, we expect that to expand across the globe for a variety of altcoins.
Thanks a lot, Michael. And yeah, I think your point on pricing is a good one because, this year had been, I would say, predominantly Bitcoin focused. And that may be a result of the fact that we had now an ETF approved on Bitcoin in the US. And we've seen, when these rumors circulate for other assets, that they also initially spike in price. And that's because of speculation, but also because of the expected demand that an ETF on any of these crypto assets would provide. And then the next one is Solana went down from 300 to currently 130. Do we think it can go much lower? I'll be happy to tackle this one. Yeah, Solana did have a significant kind of downturn from its recent all-time high. But I would say that markets, they're always kind of forward-looking. And in this case, I think following Libra, the meme coin launch associated with the Argentinian president, markets realized that this is maybe the kind of end of the meme coin craze on Solana, that there may be some kind of yeah, some stopping of this speculative activity. And so as a result, people started potentially rotating their capital out of the Solana ecosystem and into others. We've seen that Ethereum and BNB were the main benefiters of capital rotating out of Solana, and maybe the market was moving more towards tokens with actual significant utility, so utility tokens. And also the fact that we had the FTX estate unlock of $1.5 billion coming in March means that people were positioning themselves out of Solana. So personally, I would say, do we think it can go much lower from here? I don't think that there's necessarily many other headwinds, particularly for Solana. They do have a new proposal that increases the inflation on the Solana blockchain. But largely speaking, I would say markets are forward-looking. We've had a lot of this news, this negative news digested already. And I think from here, for Solana particularly, is quite a compelling entry point. We've seen how much activity it's catalyzed over the last year. We've seen how intuitive and user-friendly that blockchain is to use. And so I would say from this point onwards, I don't expect that we would go much lower from here unless there is a kind of wider industry blowback. All right, when are they moving? So this is back to the BTC miners. I would say that miners usually sell into strength when prices are high, of course. We usually see this, or we usually see a lot of selling activity from miners post halving. And so a lot of the kind of selling pressure from miners from this halving that happened last April would have already kind of subsided. So on that side, I don't know that they're that active at the moment with the current drawdown. Um, so from there, I don't actually expect them to move a significant amount of assets in the near future. Michael, I don't know if you have an angle as well. I know the US is ripe with Bitcoin miners facilities, so maybe you have another insight that I don't.
Yeah, I think, I mean, just further to your point too, we've also, seen some miners start to think about, adding Bitcoin or, maintaining their exposure to Bitcoin as like a strategic asset, and keeping it on their balance sheet, and funding OpEx, in other ways. So, I think that's also potentially happening as well. And that's why we're not seeing them, go to the market to sell as much as they have in previous cycles.
Thanks a lot. And then the last question we have, unless, of course, if there's any others, we'd be happy to answer more. But what is the biggest risk for Bitcoin? Um, I assume, of course, you mean more from like a market risk, from a price perspective risk. And I would say still, of course, the biggest elephant in the room is what could potentially happen with strategy, right? If they are forced to liquidate their holdings, it could have a significant market impact, particularly for Bitcoin. But then Bitcoin itself is not strategy, right? They are not one-to-one. And even if strategy's tactic blows back on them and they're forced to liquidate Bitcoin, Bitcoin itself will always and will still continue to be this asset that's free from centralized control, that's scarce, that's a flight to safety and an emerging store of value. So I would say market risk wise, the biggest risk is MicroStrategy or now strategy. But in terms of fundamentals, that would not, even if there is a blowback, it would not infringe upon Bitcoin's value proposition. And then, are we buying Bitcoin miners, new product? I love the curiosity. I think it's always great to see these types of questions. But again, of course, we're not able to disclose anything. But on our side at the moment, we don't have anything out there that is specifically related to Bitcoin miners. But if you've given me a new idea, so we'll make sure to take that one on board. All right. I think that's it, unless we have any final questions. Okay. I think that'll be it for now. Well, then thanks a lot, firstly to you, Michael, for joining the analyst call. It's been a pleasure having you on the call again. And then second, thanks, and the biggest thanks to our participants, of course. Thank you for making the time to be here. Thank you for your questions. And we hope that you enjoyed and that we were able to provide, some color on why is the market facing a bit of a shakedown recently? What are institutions doing? And do Bitcoin and gold make sense together?